The average man over 50 has a retirement gap of approximately $400,000. Not a slightly off gap, not a one good side hustle and you're fine gap. $400,000 between what he has saved and what he will actually need to not run out of money before he runs out of heartbeats. And the part nobody puts in the brochure, most of that gap wasn't created by a bad market. It wasn't one catastrophic decision, one divorce, one crash. It was created by 7 specific, predictable, almost perfectly invisible mistakes that happen so gradually that by the time you see them, they're already done. This video is not about motivation. It's about the math behind why so many men who did everything right end up in their late 50s running the numbers and going very, very quiet. The Federal Reserve's 2022 Survey of Consumer Finances puts median retirement savings for Americans aged 55 to 64 at around $185,000. $185,000. At the standard 4% withdrawal rate, the benchmark built from the Trinity study that generates $7,400 per year. $616 a month from 30 plus years of working, contributing, and doing what you were told. And before you say, that's median, not average, you're right. But you're also probably the guy who assumes he's above median without having actually run the calculation recently. By the end of this video, you will have run it. I've spent over 10 years running my own business, surrounded by accountants and fiscal lawyers. People who spend their entire professional lives watching money move through systems. Not how the brochures say it moves, but how it actually moves. And what they taught me, slowly and consistently, is that there is a version of finance that exists in presentations and a version that exists in reality. These 7 truths live in the gap between those 2 versions. And most men don't visit that gap until their late 50s, when it feels less like discovery and more like archaeology. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They skip inflation sequencing and fee drag, which, as you're about to see, are 2 of the most expensive omissions in financial planning. It uses BlackRock and Vanguard methodology to find the specific weak points in your plan. I only ask for your email to send the report. I don't store any of your financial data. Link is in the description. Now, the central metaphor I want you to hold on to for this entire video. Imagine a slow leak in a tire, not a blowout. Blowouts announce themselves loud, sudden, dramatic. You're on the shoulder in 30 seconds and you know exactly what happened. A slow leak is completely different. A slow leak is 1 PSI today, 1 PSI next week. Nothing that makes you pull over, nothing that registers as a problem. You drive to work, you come home, you go about your life. Your brain normalizes the gradual change because gradual change is precisely what human perception is designed to miss. 6 weeks later, you walk out to your car and it's sitting flat on the driveway. And you're standing there genuinely confused because nothing happened. Nothing happened gradually and then all at once. Your retirement works exactly like this. The mistakes most men make are not dramatic crashes. They're not the crypto implosion or the single catastrophic year in the market. Those are blowouts. And blowouts at least teach you something immediately. The slow leak is worse because it teaches you nothing until it's too late to fix it with the time you have left. Everything I'm about to tell you is a slow leak. And slow leaks have one solution. You check your gauges before the tire goes flat. Not after, before. Let me show you what the gauges actually say. In a few minutes, I'm going to show you something about the people giving you financial advice that will make you want to reread your last statement very carefully. But first, here's why the thing you've been optimizing for your entire career was never the right variable to begin with. Your salary and your net worth are 2 different numbers. They rhyme, but they are not the same number. Income is the speed at which you're running. Net worth is the score. And for most of a working life, men optimize obsessively for income, bigger title, bigger bonus, better territory, while quietly neglecting the only number that actually determines what retirement looks like. The income game is visible. It shows up on a pay stub. It creates a constant dopamine signal that you are making progress. The wealth game is invisible. It accumulates in silence, or it doesn't accumulate at all, and you find out which one it was approximately 30 years later. The National Bureau of Economic Research has published work showing that income in the top quintile of American earners correlates less tightly with wealth accumulation than most people assume, specifically because high income reliably produces high spending before it produces high assets. The technical term for this is lifestyle inflation. The common name for it is, I make good money and I genuinely don't know where it goes. Here's a parable worth sitting with. In professional sports, this phenomenon is so extreme it's almost clinical. A Sports Illustrated analysis estimated that approximately 60% of former NBA players face serious financial difficulty within 5 years of retirement. Former NFL players are documented as worse. Around 78% face significant financial distress within 2 years of leaving the league. These are not people who didn't earn enough. The average NBA salary in the mid-20s is $7.7 million per year. These are people who spent 2 decades confusing income, which is a flow, with wealth, which is a stock. You can run a massive flow and have an empty tank if none of it ever gets stored. And you can run a perfectly ordinary flow and end up with a full tank if you pay attention to the gauge. Now imagine a slightly less dramatic version of that story playing out over 30 years in a suburb near you. A man makes $90,000, then $110,000, then $130,000 as the career matures. The car upgrades with each raise, the vacation gets a little nicer, the kids go to private school, he feels wealthy because he earns wealthy adjacent money and lives a wealthy adjacent life. Then he's 58 and someone hands him a retirement projection. The tank is not full, the flow was real for 30 years, the stock never materialized. This is truth one. The fix is not complicated. It requires tracking net worth as the primary metric, not income. Net worth, monthly. The way a business tracks its balance sheet. Check your gauges. Now, fees. The average actively managed mutual fund in the United States charges somewhere between 0.5 and 1.2% per year in annual expense ratios. Some charge more. This doesn't feel like money. It feels like a rounding error on a statement that already shows numbers in the hundreds of thousands. It is not a rounding error, and I'm going to prove that with a single calculation. $200,000 invested, earning 7% per year from the market, the standard long-run index fund assumption. You're in an actively managed mutual fund, charging 1% per year in fees. Your net return is 6%. Over 30 years, at 7%, your $200,000 grows to approximately $1,522,000. At 6% after that 1% fee, it grows to approximately $1,148,000. The difference is $374,000 silently removed from your retirement over 30 years. No withdrawal notice, no email alert, no line on your statement that says, fee drained this decade. It was just not there. The slow leak. And here's what makes this the most elegant extraction in all of American consumer finance. The fees aren't taken in a lump sum. They're taken as a percentage of assets under management, which means the bigger your portfolio grows, the more absolute dollars leave it every year. The more successful you become as an investor, the more the fee structure costs you in raw dollars. The system is designed so its most profitable years for the fund manager are your most expensive ones. And 80% of actively managed funds underperform their benchmark index over a 10-year period. That's not an opinion, that's the S&P SPIVA report, published twice a year, which systematically tracks active manager performance against passive indices. 80% underperform over 10 years. Of the 20% that do outperform in a given decade, the majority don't sustain it into the following decade. You are paying more for a product that on average delivers less. That's the deal you accepted when you let someone put you in these funds without asking about the expense ratio. The alternative, Vanguard, Fidelity, Schwab index funds, charges between 0.03 and 0.2% per year. That is not a typo. 0.03%. The math on that versus 1% is the $374,000, which is not financial advice. It's arithmetic. An advisor at a large bank. Our actively managed global equity fund has outperformed the benchmark for 3 consecutive years. Someone in the back, quietly, after fees? Advisor. This is a retirement planning appointment, sir, not a podcast. By the way, hit subscribe if you like this content. Otherwise, YouTube's algorithm may genuinely never show you my videos again, which is a mildly tragic outcome in the grand scheme of algorithmic tragedy. Now, this is where it gets really interesting. Because you might be thinking, okay, fees are bad, I'll switch to index funds. Problem solved. And yes, do that. But here's what nobody is actually telling you about the timeline you're working with. Because the compound interest chart you've seen 100 times lied to you by omission. Every financial presentation you've ever sat through showed you some version of the same chart. Money goes in at 25, it compounds beautifully for 40 years, and by 65, you're sitting on a number with a comma in an impressive place. It's a beautiful chart. It is also incomplete in a way that would get a scientist fired. Here's what the chart doesn't show. It assumes you started at 25. The median American doesn't have a meaningful retirement balance until their late 30s. It assumes you never touch the money early. The IRS data suggests that roughly 40% of Americans have taken at least one early withdrawal from a retirement account, job loss, medical emergency, divorce, down payment on a house. Each early withdrawal doesn't eliminate the money, it eliminates the compounding on that money for every remaining year. And that's a very different and much larger loss than it appears on the day you take the withdrawal. And the chart assumes smooth average returns. Markets don't give smooth returns. They give lumpy, sometimes catastrophic, actual returns in a sequence that is not guaranteed to be favorable. I'm coming back to that. But right now, the number that should be on a poster, if you invest $1,000 per month starting at age 25 for 40 years at 7% average annual return, you end up with approximately $2.6 million. Start the same investment at 35. Same amount, same return, 10 years later, you end up with approximately $1.2 million. The 10-year delay costs you $1.4 million. Not in theory. In math, $1.4 million is the price tag of 1 decade of hesitation. I think about this parable sometimes. 2 brothers inherit $50,000 each when they're both 30 years old. The first brother invests it immediately and leaves it alone. The second brother says the timing doesn't feel right, maybe next year, maybe when the market settles, maybe after the uncertainty clears up. He waits 7 years. Both brothers eventually invest in the same index fund. At 65, the first brother has approximately $560,000. The second brother has approximately $330,000. The market was identical for both of them. The only variable was 7 years of good reasons to wait. $230,000 of good reasons. Check your gauges. Not next year. Not when things feel more certain. Things will never feel certain. Now, here is where I want to introduce someone who's going to keep showing up through the rest of this video, because his story runs parallel to every truth we're covering. His name is Dave. He's 57. He owns a paid-off house in suburban Ohio. He has told his neighbors, his brother-in-law, anyone who will listen, that the house is his retirement plan. He's not wrong that the house has value. He is wrong about almost everything else. The emotional attachment Americans have to homeownership is so deeply embedded in the culture that running honest financial numbers on a house feels almost unpatriotic. The mortgage industry reinforces this enthusiastically because mortgages are among the most profitable consumer lending products ever designed. So here is the math that doesn't make it into the real estate agent's presentation. Over the long run, 50 years of national data, the average American home appreciates at roughly 2.5 to 3% annually in nominal terms. Robert Shiller, who won the Nobel Prize in economics and literally built the Case-Shiller Home Price Index, puts the long-run real appreciation rate after adjusting for inflation at approximately 0.6% per year. 0.6% in real terms. Meanwhile, the S&P 500 has returned approximately 10% nominally per year over the last 50 years, about 7% after inflation. Your house isn't an investment in the way a diversified stock portfolio is an investment. It is a place to live, it provides stability and optionality, it has genuine value, And as a pure financial vehicle, it has dramatically underperformed the alternative for an entire century. And the house costs you money every single year you own it. Property taxes, insurance. Maintenance, the National Association of Home Builders recommends budgeting 1 to 2% of home value annually for upkeep alone. On a $400,000 home, that's $4,000 to $8,000 per year, every year, going out. Not compounding, not growing, just maintaining the asset you've convinced yourself is your retirement plan. Dave's house went from $200,000 to approximately $430,000 in 30 years. 2.7% annually, almost exactly on the long run average. That headline number feels genuinely good. But subtract the mortgage interest over 30 years, subtract the property taxes, subtract the maintenance, subtract the opportunity cost of what the down payment would have grown to in an index fund over those same 30 years. The actual financial return on Dave's house is, in most honest models, close to zero in real terms. Dave doesn't know this. Dave is going to sell the house in 8 years, take the proceeds, and call it retirement. It's going to be close, uncomfortably close. Stay with me, because this next part changes everything. And I mean that specifically, this truth reshapes every retirement plan that looks fine on paper but breaks in practice. The average Social Security benefit in early 2026 is approximately $1,976 per month for an individual. For a couple where both partners worked, you can approximately add them somewhere between $3,800 and $4,000 per month, depending on work history. That sounds serviceable until you measure it against actual data. The Bureau of Labor Statistics reports that households led by someone 65 or older spend approximately $57,000 per year. Your Social Security, at average benefit, provides about $23,700 annually. The gap, $33,000 per year, has to come from somewhere every single year for potentially 2 decades. But here's the reversal I've been building toward for the last 15 minutes. You think the Social Security problem is that benefits might get cut. And yes, the Social Security Board of Trustees' own 2024 annual report projected that the combined trust funds could be depleted by approximately 2035, after which scheduled benefits would be reduced to around 83% without congressional action. That's a real concern worth monitoring, but that is not the actual crisis. The actual crisis is that even full uncut benefits were never designed to replace your working income. The program was created in 1935, when the average life expectancy for an American man was 61 years old and the full retirement age was 65. Congress designed a poverty prevention floor for the small percentage of workers who lived past their working years. The math hasn't fundamentally changed. Life expectancy has, and the gap between what people expect the system to do and what the system was built to do is one of the most expensive misunderstandings in American personal finance. A man at a kitchen table doing the numbers for the first time. Social Security gives me about $24,000 a year. His wife, and we spend about $60,000. Man, wife, so we need, man, both of them staring at the table. That silence is the gap. And filling that gap is the entire reason the investing conversation matters in the first place. Check your gauges. Now let me give you the one that requires you to look at your current financial relationships honestly. Because this isn't conspiracy. This is a regulatory fact printed on government websites. In the United States, financial advisors operate under one of 2 legal standards. The first is the fiduciary standard. A fiduciary is legally required to act in your best interest, period. Recommend a product that pays you a better commission but costs the client more money, and you've broken the law. The second is the suitability standard. Under suitability, an advisor must only recommend products that are suitable for your situation, not optimal, not in your best interests. Suitable, those are not the same standard. And the majority of advisors working at banks, insurance companies, and large brokerage firms are operating under the suitability standard. They are legally permitted to sell you a product that earns them more money, as long as it isn't actively catastrophic for you. The average commission on a variable annuity, one of the most commonly sold products to pre-retirees, runs between 5 and 8% upfront, plus annual trailing commissions of 1 to 1.5%. On a $200,000 investment, that's $10,000 to $16,000 in commission on the day you sign, before the market moves an inch. The product typically includes surrender charges early, withdrawal penalties that can last 7 to 10 years. Is this suitable for some people in some circumstances? Arguably, yes. Is it in most people's best interest compared to a low-cost index fund alternative? The math says almost never. The commission structure says it sells extremely well. The Department of Labor has been attempting to expand fiduciary requirements for over a decade. Rules get proposed, challenged in federal court, delayed, revised, reissued, challenged again. We're in early 2026, and the regulatory environment is still contested and directionally dependent on the current administration. This is not a stable legal protection. You cannot assume your advisor is legally required to put your interests first, unless you have specifically confirmed that they are a registered investment advisor operating under a fiduciary duty at all times. Here's a 3-step check. 1. Ask your advisor directly, face to face. Are you a fiduciary at all times for all products you recommend? Get it in writing if the answer is yes. 2. Ask explicitly how they are compensated. Salary, percentage of assets under management, or commissions on products sold. The answer reveals the incentive structure. 3. Go to advisorinfo.sec.gov, the SEC's Investment Advisor Public Disclosure Database, and look up your advisor's name, registration type, compensation disclosures, any complaints or regulatory actions. This takes 5 minutes. The overwhelming majority of Americans have never done it. Dave still hasn't done it. Dave has had the same advisor at his bank for 15 years. He considers this man a friend. He has never asked how the advisor is compensated. He's never looked at the SEC database. He has approximately $280,000 spread across a mix of mutual funds and a variable annuity, paying a combined annual fee of about 1.3%. Over the last 15 years, the difference between that structure and a comparable low-cost index fund portfolio amounts to somewhere between $60,000 and $90,000 in lost compounding. Dave doesn't know this number exists. Dave sends his advisor a Christmas card every December. The advisor sends Dave a newsletter with market commentary and a branded calendar with a picture of a mountain on it. And now the final truth. The one that catches people who did everything relatively right, who saved, who invested, who showed up consistently for decades, and still end up with a retirement that runs out before they do. It's called sequence of returns risk. And it is, without exaggeration, the most underexplained concept in the retirement planning conversation, because it requires understanding not just what the average return is, but the order in which those returns arrive. Here's a scenario. 2 people both retire with $500,000. Both average 6% annual return over 20 years of retirement. Same average return, same starting balance. Both withdraw $20,000 per year, adjusted for inflation, to cover living expenses above their Social Security benefit. On paper, same outcome. In reality, dramatically different outcomes, because one of them retires into the first year of a major bull market. The other retires right before a significant crash. The person who retires into good early years builds a cushion. Their portfolio is worth $600,000, then $700,000 before the eventual crash arrives. They have enough buffer that withdrawals during the down years don't permanently damage the base. The person who retires into a crash in year 1 or year 2 is withdrawing $20,000 annually while the portfolio drops 30%. They're selling shares at depressed prices to fund their living expenses. The portfolio never fully recovers, not because the market doesn't come back, but because they've been removing capital during the bottom. The compounding runs on a permanently smaller base. Same average return, different sequence, completely different ending. In the 2008 crash, someone who retired in 2007 with $500,000 and maintained withdrawals watched that portfolio fall to approximately $270,000 by March of 2009. That's before any recovery. Even with the subsequent decade-long bull run, the sequence of withdrawals against a depleted base eroded the timeline of many of those plans significantly. Retired at exactly the wrong historical moment. Did nothing else wrong. And here's what makes this structurally infuriating. You cannot control what the market is doing on the day you retire. You pick a retirement date. The market is doing whatever it's doing on that date. If your entire plan is built on projected average returns without stress testing for sequence risk, you're not planning for retirement, you're betting on the calendar. 3 specific responses to this. Not generic, specific. First, implement the bucket strategy before you retire, not during. Hold 2 to 3 years of living expenses in cash or very short-term bonds. This is your cash bucket. Your investment portfolio is your equity bucket. When the market drops in early retirement, you draw from the cash bucket. You do not touch equities while they're down. You let them recover. The cash bucket earns almost nothing. That's fine. It's not supposed to generate returns. It's supposed to prevent you from selling your equity holdings at the bottom. This one structural decision can be the difference between a retirement that survives a bad sequence and one that doesn't. Second, delay Social Security claiming as long as your health situation allows. Every year you delay past your full retirement age, your monthly benefit increases by approximately 8% guaranteed by the federal government. That guarantee is not available in the equity market. From full retirement age to 70, that's a potential 32% increase in your monthly check. On a $1,500 full retirement age benefit, that becomes approximately $1,980 per month at 70 every month for the rest of your life, with cost of living adjustments on top. For most people in reasonable health, this is the highest guaranteed return available to them in the entirety of American personal finance. Statistically, most Americans claim Social Security at 62 because they can't afford not to, which is the direct downstream consequence of every single truth we've covered in this video. The circle closes. Third, stress test your plan with a Monte Carlo simulation, not a linear projection. A projection assumes average returns in a smooth sequence and tells you your portfolio will be fine. A simulation runs your numbers through thousands of possible market scenarios, including the bad sequence years, and tells you what percentage of those scenarios your plan survives. If your success rate across those simulations is 85% or higher, you're in solid shape. If it's below 70%, you have a slow leak. The time to find that out is now, not at 63. The calculator I link in the description runs this simulation using BlackRock and Vanguard methodology. Free, 15 minutes. We'll tell you more about your actual retirement readiness than the last 10 conversations you've had with a bank advisor. Dave finally checked his gauges. 2 years before his planned retirement date, someone forwarded him something to read, and he spent a weekend, an uncomfortable, honest weekend, going through his actual statements. He found the combined fee structure. He read the surrender terms on the annuity. He found the SEC disclosure database. He moved 60% of his assets into low-cost index funds. He revised his Social Security claiming strategy, planning to delay by 3 years while bridging the gap with part-time consulting work he actually enjoys. His Monte Carlo success rate moved from 61% to 82%. He did not start over. He did not find a magic investment. He did not discover a secret. He checked his gauges 2 years before the tire went flat. That's the whole story. Let me show you what this looks like with a specific set of numbers. So this doesn't remain in the abstract. You're 51. You have $190,000 saved across a 401k and an old IRA from a previous employer. You're contributing $800 per month. Your funds currently charge approximately 0.9% per year in expense ratios. You plan to retire at 65. 14 years. At 7% market return, minus 0.9% fees, net 6.1%, with $800 monthly contributions over 14 years. You project to approximately $780,000 at retirement. That's a functional number. Maybe enough, maybe not, depending on your spending in retirement and your Social Security benefit. Now, switch those funds to index fund equivalents, charging 0.06% in annual fees. Net return becomes 6.94%. Same timeline, same contributions, zero additional risk. You project to approximately $860,000. That single change, moving funds, doing nothing else, adds roughly $80,000 to your retirement. You did not time the market. You did not take on additional risk. You patched a slow leak. Now, layer in the catch-up contribution. At 51, the IRS permits an additional $7,500 per year to your 401k beyond the standard limit. That's about $625 extra per month. Increase your total contribution to $1,200 per month. At 6.94% net, $1,200 monthly, 14 years, you project to approximately $1,100,000. Not from a hot stock, not from leverage, not from timing anything, from patching the fee leak and using the contribution rules the tax code already built for you. That's a two-step intervention. Stop the slow leak. Use the tools that already exist. No complexity, no speculation, no trusting anyone who sounds like they're reading from a brochure. Just arithmetic. 3 takeaways, specific ones. 1, run the fee audit this week. Log into every retirement account you hold. Find the expense ratio of every fund. Write it down. Then look up the equivalent index fund category on Vanguard or Fidelity's website and find their expense ratio. Calculate the fee difference compounded over 20 years on your current balance. This is not a complicated calculation. It will produce a number large enough to make the decision feel obvious. 2, confirm your advisor's fiduciary status before your next meeting with them. Go to advisorinfo.sec.gov. Enter their name. Look at the Form ADV registration type, compensation model, disclosures. If they're a broker-dealer operating under suitability, you're not obligated to stop working with them. But you now understand the incentive structure you're navigating, and that information changes the conversation. 3, run your plan through a Monte Carlo stress test, not a projection. If your success rate across bad market scenarios is below 80%, you have a slow leak. You now know where to look, and you know it while you still have time to patch it. Lazy investing built more fortune than crypto memes. The tire's not flat yet. But when's the last time you actually checked the gauge?